Well, hi everyone, and welcome to this video update for the September quarter of 2023. And we're coming to you today from just outside New York City. Well, this year has been pretty astonishing, frankly. The US recession that many expected has remained elusive thus far. Year to date, the median stock in the S&P 500 is up just 3%, while the median stock in the Russell 2000 is actually down by 5%. And yet a small fraction of stocks, just 9% of the S&P 500, are up by a lot, by more than 30%. And Montaka is fortunate to own 11 of these. Now, as we all know, the price of money has increased materially and at a rapid rate since early 2022. Of course, no one really knows where interest rates will go from here, but certainly several high-profile financiers, including JPMorgan's Dimon, are advising clients to prepare for possible scenarios of rates as high as 7% per annum. The geopolitical equilibrium has changed almost as rapidly as interest rates of late, from the war in Ukraine to an expanding NATO to Russia's new partnership with North Korea to an expanding BRICS, and 4 coups in Africa so far this year alone. And speaking of rapid change, recent advances in the AI revolution, while still in its infancy, are perhaps moving at the fastest pace of all. So you may have heard ChatGPT can now see, hear, and talk. Microsoft is releasing its Copilot in the coming days. Meta AI is your own personal assistant being infused into Meta's properties and hardware. Spotify is using AI to translate your podcasts into your choice of language. And ServiceNow is using generative AI to dramatically increase the productivity of internal and external service assistants. So this is why we think the future will look pretty different to the past, and why there will be more divergence between winners and losers, and why we believe Montaka's analysis of evolving global dynamics will continue to be of service to clients. We remind investors that over the very long term, great shareholder returns are overwhelmingly driven by compounding earnings power, and not by changes in valuation multiples, which interest rates and other things are affecting today. And this is why we remain very happy with Montaka's major investee companies. These are businesses that have tremendous advantages, and we believe these remain underappreciated today. Furthermore, we have been particularly pleased and impressed by the significant cost controls affected by these businesses of late. Now, both of these characteristics are very supportive of higher long-term earnings power. In Salesforce's recent result, they included the most significant demonstration of this that we've seen recently. So in the quarter, the company's operating margin was more than 10 percentage points higher than a year ago. And speaking of cost controls, this is one of the reasons we remain so interested in Spotify as an investment opportunity. Of course, it has a wide lead in global audio streaming and tremendous data advantages. And we think these data advantages will result in further monetization opportunities down the road. But frankly, it is good old-fashioned cost-based rationalization that will be the primary driver of substantial profit growth over the next 1 to 2 years. And we believe all of this remains underappreciated by the stock market today, as Lachlan describes in the case study that we included in our quarterly letter, as well as this month's Montaka Monocle. Our portfolio turnover continues to remain very low, and this is a direct consequence of the quality and upside potential of Montaka's investments that we see. That said, there were 2 small changes to the tail end of Montaka's portfolio during the September quarter. So we exited St. James's Place, and unfortunately we did not make money on this investment, though we had risk managed the position down over time into one of our smallest. While this stock is probably still undervalued today, believe it or not, we have not been happy with management's decisions and some of the decisions they've made over the last few years. And we frankly just see better opportunities elsewhere, including in existing opportunities that we already own. We also sold Bank of America, one of our tactical investments. We made money on this quickly as bank stocks rebounded following the collapse of Silicon Valley Bank earlier this year. Longer term, again, we see better opportunities elsewhere for this capital. Overall, Montaka's portfolio remains weighted heavily towards US domiciled investments. While we do have some modest exposure to China, we have deliberately ensured there is minimal ownership of businesses with cross-Chinese border exposure on both the revenue side and the supply chain side, given the ongoing geopolitical risks we see. Finally, we released a new white paper in recent days that assembles a collection of the empirical elements that underpin superior active management performance. So these include a highly concentrated investment portfolio, owned with patience, and enabled by the right manager structure. As you know, we have deliberately evolved Montaka over the years to be aligned with what really works, as demonstrated by this academic research. So please take a read, and we'd love to hear any feedback you have on this white paper. Okay, well, that's it for now. We thank you for your ongoing partnership with Montaka, and we look forward to connecting with you again soon.